Now, the mood among investors has changed after the Fed and other central banks around the world have tightened their monetary policy to tame inflation. Emerging markets, and that includes India, have been the worst hits, and this because they've witnessed record sell-offs by foreign institutional investors, FIIs. So how does this affect market returns for the retail investor? That's what we're explaining today. Now, the US Federal Reserve and other central banks around the world have raised their borrowing rates aggressively to tame runaway inflation. This has led to fears of recession in major economies around the world. And this in turn has resulted in investors parking their money in safe haven assets like the US dollar. The US dollar index has spiked to record levels, and experts are suggesting that they may not have peaked out just yet. When the dollar strengthens against other currencies, the rewards for foreign investors staying invested in other markets starts declining. And the worst affected among all the markets are those of emerging economies, including India. Indian equities have seen record outflows in the year-to-date period. FIIs have sold equities to the tune of $24 billion in this period. And just to put that into perspective, FIIs invested around $23 billion since 2020. That effectively means that FIIs have sold more Indian equity in 10 months than they've bought in the last 3 years. And experts believe that the trend may continue in the short term. The reason for that is that inflation, whether it's the US or in Europe, remains sticky. The Fed Chair, Jerome Powell, has hinted at further monetary tightening to bring down the cost of living for American citizens. Other countries are likely to follow suit, but every cloud, of course, has that silver lining. Indian markets have outperformed their developed market peers in the year-to-date period. The reason for that is the strong buying interest that is shown by domestic institutional investors and retail investors in India. Domestic investors have bought equity to the tune of $20 billion so far in 2022, largely insulating Indian markets from economic shocks. So if you're a retail investor, the big question on your mind should be whether you should invest in Indian markets or not. Well, for the moment, data suggests that India is the fastest growing major economy in the world, and experts suggest that FIIs are making a mistake by selling Indian equity. Market veteran Shankar Sharma recently tweeted, and I quote him, "If you need any proof that Wall Street and FIIs know next to nothing about investing, look no further than their India selling data in the past 18 to 20 months. It takes special idiocy to sell the best market in the world." End of quote. Well, there you have it. If market experts are to be believed, India is the best market to invest in and stay invested in for handsome returns, at least in the current scenario.